Stocks are volatile, inflation is still rising, and let's be honest, opening your bank app these days feels like walking in on your grandparents doing something you really wish you could unsee. It's unsettling to say the least. Is this just a blip on the radar of our economic joyride, or are we headed straight for a financial crisis bigger than a Kanye West rant? Media Group, host in studio talking about finance, financial expert explaining market trends, animated text, welcome to your channel name, where we break down the confusing world of money, markets, and economic mayhem, so you don't have to. Remember back in 2021 when inflation first started creeping up like a bad Tinder date? Central banks, those beacons of economic wisdom, assured us it was transitory. They whispered sweet nothings like, "Don't worry, it's just a temporary blip due to supply chain issues." Well, here we are in 2025, and inflation is about as transitory as a Kardashian marriage. We're all still grappling with the high cost of, well, everything. Food prices are enough to make you consider a life of foraging. Housing costs, forget about it unless you're cool with living in a yurt made of credit card debt. And don't even get me started on interest rates. They're higher than Snoop Dogg at a Cypress Hill concert. Why? Because central banks in their infinite wisdom are still trying to stomp out inflation without sending the economy into a death spiral. It's like trying to perform surgery with a chainsaw, messy, unpredictable, and likely to leave some permanent scars. Now some folks, usually those living in ivory towers built on stacks of stock options, will tell you we've dodged the recession bullet. But let's get real. Go talk to a small business owner who's barely keeping their doors open, a renter who's being priced out of their own neighborhood, or anyone who's tried to navigate the soul-crushing labyrinth of getting a mortgage lately. Does any of that scream thriving economy to you? Real wages are going up slower than a sloth in a staring contest. Consumer debt is about as high as a giraffe's blood pressure. Look, if this isn't a recession on paper, it sure as hell feels like one for millions of people just trying to keep their heads above water. It's like being told the Titanic only has a slight water feature. Technically, maybe, but good luck convincing anyone on board that it's not a big deal. Ah, the stock market, that fickle beast that everyone pretends to understand. On the surface, things might seem rosy. The S&P 500 is up, but let's be honest, it's basically being propped up by a handful of tech giants and AI companies that are starting to feel less like innovations and more like Skynet in a turtleneck. Strip away those top 5 companies, and the rest of the market looks shakier than a giraffe on roller skates. It's like watching a beauty pageant where one contestant is a genetically engineered supermodel, and the rest are just trying to remember where they put their pants. While Wall Street's busy throwing money at anything with artificial intelligence in its name, Main Street's dealing with layoffs, store closures, and the crushing realization that the robots are coming for their jobs. This disconnect between the stock market's sugar rush and the real-world economy's sugar crash, yeah, that's not a good sign. It's like watching a canary do the Macarena in a coal mine. Entertaining, sure, but probably a sign that something's about to go very, very wrong. Remember when everyone thought they were a real estate mogul back in 2021, thanks to those rock-bottom interest rates? Well, those days are gone faster than a politician's promise during an election year. High interest rates have basically thrown a bucket of ice water on the housing market. Buyers are stuck staring longingly at Zillow listings, wondering if they can afford a cardboard box within a 50-mile radius of their jobs. Meanwhile, sellers are clinging to their low fixed-rate mortgages from 2021 like grim death, refusing to let go. It's a standoff worthy of an old western, except instead of tumbleweeds and gunfights, we've got bidding wars and crippling debt. Experts are predicting that housing is about to go one of two ways: a dramatic crash that would make the 2008 crisis look like a minor dip in the road, or a deep freeze that could last longer than a Taylor Swift re-recording marathon. Either way, it's not looking good for anyone who needs to buy, sell, or even think about the concept of shelter in this economy. So, what fresh hell awaits us in the coming months and years? Well, if you ask a room full of economists, You'll get enough different answers to make your head spin faster than a dreidel on Hanukkah. Some of these optimistic souls believe inflation will finally chill out, interest rates will drop faster than your phone's battery life on a hot day, and we'll all be sipping margaritas on the beach reminiscing about these uncertain times. Others, the more cynical bunch, and let's be honest, probably the more realistic ones, fear we're teetering on the precipice of a full-blown financial meltdown, the likes of which we haven't seen since the Great Depression. They point to the yield curve, which has inverted faster than a politician's stance on a hot-button issue, and historically, that's about as reliable a recession indicator as you can get. And let's not forget the geopolitical tensions, trade instabilities, and the looming chaos of an election year. It's enough to make you want to build a bunker, stockpile canned goods, and invest in a lifetime supply of antacids. Look, the only thing we know for sure is that uncertainty is the name of the game. It's like trying to predict the weather in a hurricane. You know it's going to be bad, you just don't know how bad, or what you should be wearing. So, in this economic thunderdome where the only rule seems to be hope for the best, but prepare for the worst, what can you actually do? Well, for starters, put down the pitchforks and step away from the Doomsday Prepper's starter kit. Panicking is about as helpful as a screen door on a submarine. Instead, focus on what you can control. First and foremost, build yourself an emergency fund. I'm talking about 3 to 6 months worth of living expenses, stashed away in a safe, accessible place, not buried in your backyard next to your collection of Beanie Babies. Think of it as your financial safety net, there to catch you if, or let's be honest, when things get bumpy. Second, stay invested, but diversify. Don't put all your eggs in one basket, especially if that basket is woven from volatile tech stocks and fueled by the hopes and dreams of Silicon Valley billionaires. Spread your money around like you're trying to win a game of financial bingo. Stocks, bonds, real estate, maybe even a sprinkle of gold, just in case we end up bartering for our groceries. Third, avoid high-interest debt like it's a politician with a microphone and a captive audience. Now is not the time to be racking up credit card bills on things you don't need. And finally, stay informed. The more you understand about what's happening in the economy, the better equipped you'll be to make smart decisions for yourself and your family. Remember, knowledge is power, especially when it comes to your finances. So there you have it. The economic landscape in 2025 is about as predictable as a toddler on a sugar rush. But hey, at least we're all in this together, right? If you found this breakdown even remotely helpful, hit that like button harder than the Federal Reserve hits the interest rate button. Subscribe for more weekly insights into the wild world of money, and let us know in the comments how your wallet's holding up in these interesting times. We're all in this together, folks. Stay smart, stay ready. You're watching Blackline Magazine.